So what exactly is in Trump's big, beautiful bill? Trump signed it, the markets moved, and depending on who you are, this bill could be a financial lifeline or a ticking time bomb. Today, we're breaking down Trump's one big, beautiful bill, what's in it, and how it affects your wallet, your retirement, your investments, and what might be coming next. Officially known as the H.R. 1, this bill is Trump's second-term economic keystone. It's massive, covering taxes, benefits, business policy, social safety nets, and even energy regulations. The nickname One Big Beautiful Bill isn't just branding. It's literally designed to roll dozens of priorities into a single vote. Think of it as the spiritual sequel to the 2017 Tax Cuts and Jobs Act, but this one goes even further. So firstly, let's talk about what people care about the most: taxes. So this bill makes permanent the 2017 tax cuts, keeping income tax rates lower for individuals and businesses. But it goes beyond that. There's a new $6,000 tax deduction for seniors over 65, and it eliminated the federal income tax on tips and overtimes for qualifying low and middle income workers. It expanded the SALT deduction cap, helping homeowners in high tax states, and it boosted the child and adoption tax credits. So on the surface, that sounds great, but there's a trade-off, because those tax cuts will add an estimated $3.4 trillion to the national debt over the next 10 years, according to the CBO, and someone has to pay for that. So to offset the tax cuts, Trump's bill slashes spending in key areas. Over $1 trillion cut from Medicaid, $186 billion reduction in SNAP food assistance, increased work requirements for welfare recipients, and reduced funding for climate and clean energy programs. And if you're receiving government assistance, these cuts are enormous, and they've already been drawing lawsuits from advocacy groups and states. So to be clear, this bill doesn't cut Social Security or Medicare directly, but it does change the structure of how some funds are allocated. There's a new formula for Medicare reimbursements that could lower the payouts for some hospitals. Translation? These programs aren't cut yet, but this could be the beginning of a slow unraveling, especially if inflation spikes or the bond market reacts poorly. For businesses, especially tech and manufacturing, this bill is a goldmine. 100% capital expensing returns, letting businesses immediately write off big purchases. Corporate tax rate remains at 21%, and deregulation for AI, biotech, and oil and gas. Additionally, there are tax incentives for reporting overseas profits. Stocks in defense, AI, oil, and construction have already surged. If you're an investor, this is a signal to watch. So what does this mean for housing and interest rates? So the bill allows for the first time homebuyer credits to return, but only if the Fed rates drop below 4%. There's also a tax break for developers in rural and low-income zones in an attempt to stimulate supply. In theory, that's good news, but the Fed Chair Jerome Powell made it clear this kind of stimulus may delay rate cuts and complicate inflation control. So while real estate might boom, mortgage rates could stay higher for longer. So who are the winners and losers during all this? Well, the winners are high earners in red states, retirees with large portfolios, investors in tech, energy, and AI, and tipped and hourly workers. Losers might be low-income families relying on SNAP, medical recipients, green energy companies, and long-term deficit hawks. So this bill has been called economic rocket fuel and a power keg. It all depends on where you stand. Now, Democrats have pledged to repeal major parts of the bill if they regain power in 2026. International credit agencies have warned about a downgrade in U.S. credit, and some GOP members are privately concerned that the bill spends too much while cutting too deep in the social areas. So initially, the markets soared, especially the S&P and the Dow Jones, because they're tied to energy and defense. But bond yields have started to rise again as investors anticipate more treasury borrowing to fund the deficit. Now, this is a double-edged sword. Stocks may rise in the short term, but higher yields may slow lending, hurt credit, and impact small businesses. So what should you do now? If you're an investor, diversify into strong sectors like industrials, AI, and energy. And if you're nearing retirement, reassess your tax strategy, especially if you're in a high bracket. If you rely on government benefits, track implementation dates and talk to a financial advisor. And everyone should be watching inflation, interest rates, and the bond market over the next 3 to 6 months. So this bill is big, it's bold, and depending on who you ask, brilliant or brutal. But one thing's for sure, It's going to reshape the economy, your taxes, and your financial future. And don't forget to subscribe to dive deep into more economic policies, investing, and how to protect your money in uncertain times. I'll see you in the next one.